Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Good afternoon, everyone. Welcome to Savant's live webinar, Mind Over Markets, helping to emotion-proof your portfolio. Thank you so much for joining us today. My name is Jake Lusher. I'm a financial advisor here in our Rockford, Illinois office, and I have the pleasure of speaking with you today about how to best, again, kind of emotion-proof your portfolio. And if it otherwise doesn't meet the eye as we kind of go through this, it's ultimately going to come back to a financial plan, which we're going to speak through today as part of our session. And with that, we'll go ahead and get started. So this is really the agenda of items that I'm planning to cover today. I think with anything, as one of our core values as a firm is lifelong learning, we always want to make sure that investors have education, because with education of these things comes empowerment. With empowerment comes good decision making. So the education side is part of what I'm hoping to communicate today about volatility, markets, things that are otherwise normal and commonplace for us, which have to be otherwise normal and commonplace for you if you're ultimately going to have a successful investment outcome. So we'll talk through volatility and, of course, its causes. I also want to talk about some of the emotional biases that people have, which is a topic within science called behavioral finance. We'll also then talk about the strategies to help avoid maybe some of the impulsive decision making that could happen, and then really aligning an investment approach that's going to be tailored and unique to you to help you drive success. So with that, we'll jump right into market volatility. Now, with all the things we'll talk about today, I do want to underscore how normal things like volatility is. What we talk about with financial planning and with investments in general is volatility is really just the price you pay to earn long-term return. And as part of a day-to-day, month-to-month, quarter-to-quarter, year-to-year market swings, ups and downs are typical. The hardest part, unfortunately, as the consumer is, while it is typical and it has always been typical, it has never been foremost in our minds as much as it is today because of all of the technology resources that we have, whether it's the phone in your hand or the watch on your arm, or if it's the iPad or laptop you're carrying around with you, or news media on TV. All of the news around financial services and its tie-ins with overall economics and markets and all of the political commentary that happens on a daily basis makes all of the risk in the market seem much more prevalent than it has been in the past. Well, that's actually not the case. So when we think about this slide that is on screen, really this tries to help understand the point that it is normal. And this is looking at total US stock market returns on a calendar year basis going back to 1979. Now, the green bars represent where the return ended for a given year. So for example, in 1979, on the far left-hand side of the screen, the overall US stock market returned somewhere in the neighborhood of about a 25% return. However, you'll see surrounding each one of those green bars a couple of barbells. So there's lines at the top, like a hash mark, and there's lines at the bottom as a hash mark at the bottom. And that represents the highest point the market was in that given calendar year versus the lowest point in that calendar year that the market achieved. Now, what you can really see that meets the eye here is that the ending calendar year gain doesn't often always match the top or the bottom. It kind of falls somewhere in between. Well, what is on the barbells? What is on the kind of the outside edges of those green bars? It's really how much the market varied throughout the year at its highest point or at its lowest point. So 2020 is a very stark and most recent example of how severe this can be from a volatility perspective, which can sometimes be bad volatility. In the case of the stock market being down significantly in April of 2020, down as much as 40%. It can also mean that stock market returns are so significant where they're actually up 80% from their low point. So from April of 2020 till about September of 2020, there was about an 80% return. Of course, that's not where the year ended, but it still had ultimately a healthy return from a year-to-year perspective. The point of all of this is we can react and find different reasons whether the markets are performing quite well or quite poorly, where it may ultimately lead to a poor decision, but the inaction or the lack of reaction around these different kind of barbelled moments are the things that kind of help instill that discipline. So seen in a different light, kind of the history of market declines and volatility, this is trying to illustrate the size of a decline. Now, in financial services, we have different names for these things. So, for example, a 5% or more decline in our industry, that's called a pullback. A 10% decline, that's called a correction. So, if we see on news media that, oh, the market's going through a correction, well, that means a 10% decline. And then on the far right-hand side, a 20% decline, that's actually a bear market. Now, on the screen, you'll see that there's a frequency of how often these occur. And so, to the point that I was making in the previous slide about how much that return can vary from where it ends at the end of a calendar year, these swings of 5, 10, even 15% can be quite common. A 5% or more decline in stocks, in this case, the S&P 500, happens about 2 times per year. Again, doesn't mean that the market ends up being down for that calendar year. It just means that there was some downside risk at some point during the year, which led to a 5% decline. Now, that doesn't last forever, right? And again, this happens often. So this most recently happened in July 2024, as measured through the end of last calendar year. Guess what? It's actually happened again here this year. A 10% decline also doesn't last forever. So that happens less frequently, about once every 18 months. And that can last about, half a year or so from the top to the bottom of the market back up to the top. And up until this year, that again, the most recent one was July of 2023, but that also happened again this calendar year. So these things are not infrequent. They're part of normal investing. And again, it's the price you pay to earn long-term return, your ability to withstand these things. Now, those 20% declines, those bear markets that we hear about, those are quite a bit less frequent. But as you can see, once every 6 years still isn't uncommon. If you think about someone's savings, if they're leading from a point when they first start in their career to the point of retirement, or if they're going from retirement to the end of their life, the average investor from either one of those time periods may see as many as 4 to 6 bear markets during accumulation or during spending. And the decisions you make around those different significant downward turn in stock market returns can mean the difference between whether you retire or, if you are retired, how well you're retired. So those different considerations are important. And again, having the discipline is important. So we often hear as advisors that when we work with clients, the phrase, well, it has to be different this time, or it feels different this time. Now, I certainly can't discount the emotional aspect to investing because it is and can be very emotional. But this chart really helps to articulate the point that at any point in the last 60 years here of time, you could find a reason not to invest, whether it's to stay invested or to make new investments, because it's scary, or it can be, all the time. When you go back to the 70s when we were going through the oil embargo, there was a substantial downturn in stocks as a result of that. We had a period in the early 1980s where they talked about the death of equities. There might be some on this call that actually remember the flash crash of '87, right? That happened where the Dow dropped 23% on Black Monday. Of course, there was multiple wars in this time period where Iraq invades Kuwait, or we have the 9/11 terrorist attacks, and then the war in the Middle East. And of course, you have all of these different weather-related events that have happened over time. And now we're, of course, dealing with tariffs or trade war. Right? There's always going to be a reason where you wouldn't want to stay invested, or it becomes very difficult to stay invested and stay disciplined. But if you are disciplined, the market will reward you. There's going to be ups and downs, and that's normal. It isn't linear, which means you don't earn a flat level rate of return over time every single year. And you have to sustain these things and have a good plan around them to otherwise be successful. So again, market volatility is common. It's normal. It happens all the time. It's never going away. But if you can be patient and disciplined, you will be rewarded. Now, human behavior is the other side of this, right? Markets are rooted in mathematics, science, and there's a lot of academic support, which we'll talk through, which can help guide good decision making. But after all, we are human beings, and humans can kind of get in their own way from time to time. And so there's these different biases that we have through a study in behavioral finance, which has become much more important in the last 30 years. And 3 I kind of wanted to talk about here today as it relates to how humans actually behave when it comes to making investment decisions. One of those is called herd investing. Obviously, the picture on the screen isn't hopefully what's going to happen or hopefully what anyone wants to do, but this idea that we're all just following the next person in front of us. or the group that seems to be doing the right thing or maybe doing the right thing. This idea of following the leader, right? Doesn't necessarily mean you're going to go off a cliff, but in investments, it can lead to some very poor outcomes from time to time. Could also get rich, but there's also the chance of getting poor depending on the decision that gets made. So this chart has quite a bit on it, right? This is lots of different colors, a lot going on, but I want to take a moment just to explain it. So on the left-hand side is a legend of sorts. So each one of those boxes represents a different asset class. So in dark blue is US large companies. You scroll down to green, well, that's now international stocks, whether they're large, small, or emerging markets. In the yellow colors, we have bonds. In the orange colors, we have different alternative investments. So think about that as the legend for the rest of the chart. The rest of the chart simply breaks down a calendar year. So 2007, 2008, 2009, all the way through the end of 2023. And this simply ranks the very best performing asset class at the top, all the way down to the very worst performing asset class at the bottom in each given calendar year. So for example, in 2007, if you look at that legend again, the very best performer was emerging markets, which was up about 39.5%. So that was the top performer in 2007. If you compare that to the worst performer in 2007, well, that was global real estate, which was down 11.1% in 2007. 2008 told a different story. Of course, we were going through the financial crisis, as I was pointing out, with one of those reasons that it might be different this time. That was led by trend following, which is kind of a downside hedge on different asset classes in that legend there. Followed by the worst performer, which was emerging markets, which was down 53% in 2008. Now, where hurting this idea of emotional biases can come into play is it becomes very easy that if you don't have the rest of the chart to look at, if you simply only looked at maybe 2007 or 2008 as your guide for what will do well moving forward, and you're trying to essentially jump on the bandwagon from the thing that is performing best right now, right, following the leader, well, then you can kind of see what happens. So if I had an ability to cover up 2009 and beyond, you might say, well, 2008, well, what may have done best next year, right? Your guess probably wouldn't have been emerging markets, which happened to be the best year in 2009. It was the best of all the other asset classes. You may not have guessed, trend following as an example, but if you did, you saw that trend following became the very worst performer in 2009 after being the very best performer in 2008. And that same kind of pattern or lack of pattern happens every single calendar year. So if we simply just selected the very best asset class to invest in, or the top couple of asset classes to invest in on a calendar year basis, and we were essentially following the leader, you actually lead yourself into more harm than good, because you're always buying what is essentially most expensive, as opposed to buying the things that are on sale or cheapest. So the question I'll ask you, and that I'll leave you with, is if you see any discernible pattern when you look at this. I'm giving you a moment to kind of think a bit. The answer is probably, well, of course not. There's no discernible pattern here. We can't predict what's going to be best moving forward. So from a financial planning perspective, when we think about the math and science of all of this, the goal is to kind of own it all, right? Not just necessarily seek out the best performer from last year, put all your eggs in that basket, and then do the same thing year in, year out. Because no time in this, almost 20-year period of time would you have been right by simply selecting the best from every year and investing in that piece. So herding can be difficult. What about if you just look at the 10 largest companies? Now, again, there's a lot going on this chart. But what this basically looks at is it looks at the last 100 years of US stock returns. And it says it just kind of looks at the largest 10 individual stocks in the United States. And all this is trying to articulate is the return of the largest 10 companies in the United States before they become the largest 10, and then after they were the largest 10 in the index. So like in the last decade, for example, there's been a lot of news, especially in the last 5 years, about the Magnificent Seven, right? The 7 largest technology companies, which have driven a lot of the US stock market return. Well, over time, you go all the way back to 1927, that market leadership, so the best 10 companies in the index, or the largest 10 companies in the index, change leadership regularly. And we know this because we have the history, but the chart is very interesting in that it articulates if you look at that red bubble in the middle, so the start of the first calendar year in the top 10, what that says is up until that point, the 10 largest companies in the United States had the performance before the red bubble. So, for example, 3 years before, the largest 10 companies met that position as being the largest 10 companies in the United States had an annualized return of 28% per year. That's an incredible return. And if you said, boy, those 10 largest companies are returning really high rates, even 5 years before and 10 years before, let's start putting all our eggs in just those 10 largest companies, or the most recent example, the Magnificent Seven, you can kind of see what happens after those very large companies are at their largest point. It's very hard for an oak tree that is fully grown and mature to continue growing in size at the same rate. It's much more easy for a sapling to grow and double in size at a regular rate. So once those 10 largest companies became the fully grown oak trees, you can kind of see what happened in the years afterwards. They often fail to repeat and fail to continue growing and fail to continue attracting new investors. And a lot of times within 3, 5, and 10-year period after the fact, they've actually lost return on an average annualized basis, which means they shrunk in value. Now, it remains to be seen what will happen with the 7 largest technology companies, which have driven a lot of the return here in the last 3 to 5 years. They certainly haven't had a great start to 2025. But if you simply operate your investment process buying what has done well and essentially following the leader, you often find yourself that you're now following other leaders in the future because you've fallen way behind. So try to avoid that aspect of hurting. Now, another one is loss aversion. Loss aversion is easy because it's kind of like gambling. If you talk to folks that otherwise have been to a casino before, they may tell you about the time they walked up to the slot machine, they put in $10 and they won $1,200, right? But what they didn't tell you is that they sat at that slot machine maybe for about 4 hours, spent $300. They lost all of that, but they got that large winning as a result of that one pull on the slot machine. It's because we tend to favor more of those wins. And although they don't necessarily feel as good over the long run, they feel good instantly. But then we're really frustrated about all those losses. So sometimes we tend to avoid wanting to participate because we're so worried about losing money in the future. And so when I think about this, I often pull back, more of a longer term view and identify this idea of, well, what does risk really mean? This chart identifies the growth of just a single dollar going back over a full 100-year period of time in both US small companies and US large companies, so stocks, which have the highest potential growth, but the highest potential risk or volatility. Long-term government bonds, which again have a little less volatility and a little less return. Treasury bills, which is kind of like cash. And then inflation, which is obviously how much goods and services cost on an annual basis every year moving forward. And so this chart looks at that growth of a dollar over this long time period and said, what would that dollar of investment grown to? Well, inflation, $1 of goods and services in 1926, it takes about $18 today to buy that same basket of goods that it took $1 100 years ago. So quite a bit more expensive, right? That annualized rate of return is about 2.9%. Cash or treasury bills, well, those grew at 3.3% per year. So you got paid a little bit of incentive for having money in the bank, but the bank is risk-free, meaning assuming the FDIC continues to exist and you have your dollar deposits under those FDIC limits, you're insured to essentially never lose your money. Well, because of that, right, because of that risk being so low, you're not paid a lot of return relative to inflation, but at least you got a little bit. Now, maybe after taxes, not a ton, but you got a little. That gold bar, which is that government bonds, you did get paid a little bit more, but as you can see on the chart, it's a little bumpier of a path, right? You have kind of a bumpier ride, and then once you get to the mid-80s, interest rates were sky high. Some people on this call may have had a 10% mortgage rate or a 15% mortgage rate. Well, bonds, they're interesting because as interest rates come down, which is what they did for about 40 years, prices of bonds go up. So all of a sudden, bonds started returning at a higher rate because the price of bonds were increased. But obviously, you can see the volatility increases over time as well. And then stocks, of course, those are the most significant change, on a year in, year out basis. You can see that an investment in small companies, for example, may have lost almost everything during the Great Depression in aggregate, but then they recovered from that point and produced the most return, but the most significant risk. And you can see that by the bounciness in the chart. So $1 in small companies, almost $65,000 of value today from just $1 of investment 100 years ago, which is about a 12% rate of return. Now, we think about this from the concept of loss aversion. I often like to think about it as when you invest in stocks, while it doesn't feel good in the short run because we could be going through a lot of downside volatility, if given enough time, the worst alternative in stocks, meaning the lowest point in stocks, is likely better than the best point in some of the other conservative investments. So if you invested, say, money in 1974 on those stock categories, and you invested money in bonds and in cash during 1974 as well, and then you fast forward, say, to 2008, and you can kind of look at the downward trend in 2008 in both large and small stocks at that point in time. While it wasn't very fun to own stocks during 2008 and 9, and they were down 40 to 50% from their highs, they still produced a larger long-term return than bonds or cash during that period. And yes, that's a 30-year window, but that same argument can be made over a 5-year period, a 10-year period, even a 15-year period as well. The worst alternative in stocks, the most aggressive investment, can still be better than the best alternative in either bonds or cash. So if you are so worried about losses for the sake of eking out a gain over time and you fail to participate, it can make a substantial amount of impact long run. Now, if we zoom into just cash, this kind of gives the idea of just sitting on cash because you're afraid to invest in the potential of a loss in the short term, the impact that actually have on your return. So what this articulates is it kind of tells you the likelihood or the probability of cash outperforming stocks over time. So while it may feel good to have the money in the bank because it is fully insured and the FDIC protects it, as you can see by the chart, over a 1-year period of time, it only has about a 30% chance of outperforming stocks. And the further you go out, the less likely that becomes. So by simply avoiding the loss because you're worried about the return in stocks, maybe not panning out over a short or intermediate period of time, most often you'd be wrong having money just in the bank because you're so worried about the potential loss that could be there relative to earning a gain. We'll bring this back to more of a financial planning context in just a moment, but I wanted to kind of get this idea across that waiting to participate is often the worst alternative you can select, even if it means you might absorb a little bit of a loss in the short run. That can happen, but again, as we looked at before, discipline in investing in markets over time does pay off. The third cognitive bias that I wanted to point out with human emotions is kind of this idea of recency bias. In investments, this means that the thing that has performed best in the past, you kind of get this idea that, well, it's going to continue going, right? So what this slide shows is it kind of looks at what we call market leadership. So the rate of return between US stocks and international stocks over time. And that market leadership changes. But there are time periods that if it goes long enough, you can make the argument, well, why would I invest in international stocks because US has done so well for so long? Or why would I invest in US stocks because international stocks have done so well for so long? On the right-hand side of this chart, if you look at the 3 decades of just the 2010s, the 2020s, and then of course, just in 2024 as an example, there could seemingly be no reason why you would ever invest in international stocks, which is the green and light green bar. So the EFA, those are developed countries. So like Europe, for example, and Japan. EM, that's emerging markets. That's the Brazils, the Indias, and the Chinas of the world. And if you looked at in the 2010s, well, the S&P 500, the largest 500 companies in the United States, they returned a 14% annual return every year, whereas international stocks only returned 4 to 6%. And you could say, well, hey, those are done so great, they'll continue doing well. And you wouldn't have been wrong from 2020 to 2023. The S&P 500 has continued to do well. So this idea of recency, they've done well in the past, they'll continue doing well in the future. That certainly panned out in the last 3.5 years or so. Well, if you flip the coin to 2025, it's actually been opposite. The S&P 500 has experienced some of the most significant downturn, whereas international stocks have provided a very large increase in return, kind of what it was like back in the early 2000s. So if you're looking at that middle of the screen, you say, boy, the 2000s were kind of an interesting time period. That was just on the tail end of the tech bubble, which is in the 1990s. The S&P 500 was producing an 18% annual rate of return. And International stocks weren't doing poorly. They were up 7 to 11% per year. But the 2000s, it kind of flipped the other direction, where if you only had S&P 500, meaning the largest 500 companies in America in your portfolio, you actually lost 1% per year for a full 10-year period of time. They called that the lost decade for US stock investors. So if you thought because in the 1990s, all the technology companies, for example, were driving so many of the returns that it was likely to continue because they've done so well recently, that would have been a decade where you would have struggled mightily if you didn't have the otherwise diversified exposure into international stocks. It remains to be seen what's going to happen in 2025 and obviously over the next 3 to 5 or even 10 years. But the whole point of this slide is you don't necessarily want to have all your eggs in just US. You don't want to have all your eggs in just international. You want to have it all because we don't know based on recent past what will perform well in the future. There's this old adage in financial services, past performance is not indicative of future results. We don't know. Your advisors don't know what's going to do now well in the next 1, 3, 5, or 10 years. We have suspicions and we have ideas of how we'd best like to allocate in portfolios, but ultimately you need to own it all because you don't want to be caught in a situation where you significantly fail to keep pace with global markets because you stuck it in one category in hopes that based on recency, it would continue. So what strategies do we have to help avoid making impulsive decisions and kind of falling prey to some of these cognitive biases that can take place? Now, I certainly am not going to read this slide to you. You can look at it and identify what are the things that we can do and the things we shouldn't do or can't do. I talked about a couple of these in the last several slides, and I'm certainly going to talk through more as we move forward here. But it ultimately comes back to having a plan and avoiding emotional input into the investment process. This is one of my favorite slides. So if you're looking to screenshot one with your phone or write something down that's most important, we call this the roller coaster of investor emotion. It's this idea that when it feels the best, euphoria, as the market is growing in value, we have optimism, right? And then there's excitement, and then, boy, there's thrill. I could maybe have a side hustle where I put aside $10,000 or $25,000 and start investing in stocks on a day-to-day basis in hopes they'll continue growing. And that might be good for a while, and then it becomes euphoric. All I'm doing is making money. I can't lose, right? That is usually the point when there is the most risk in the markets because people have become essentially overconfident in their abilities to manage their own affairs, or sometimes investment managers that are actively managed portfolios are essentially overemphasizing their skill set because things have gone so well. That is usually when there is the most risk. And on the other side, of course, when the market starts going down in value, we become anxious about, things are becoming a little bit uncertain, or it's going to be different this time. And then, of course, the market ends up falling to such a low point that we're almost despondent. That's usually when there's the point of maximum financial opportunity. Warren Buffett called this, I'll paraphrase, but called this, market emotions, right? The most efficient mechanism for transferring wealth from the impatient to the patient. And when there's that point of despondency and that point of impatience, it's the wise investors, the one that kind of understand this process and understand how emotions can get involved in investments on a regular basis. The ones that are patient can otherwise profit from this because the point of financial opportunity is when things feel the worst. So if you remember nothing else from the discussion I'll have with you here today, remember that when it feels best, there's usually the most risk. And when it feels the worst, that's usually the best time to invest. And there's ways around this from a portfolio management perspective. You can actually help guide and deal with some of these emotions. But I wanted to point this out because this is always going to happen. This is volatility in a nutshell, whether it's within a day, month, quarter, or within a calendar year. Another element you can do is bring it back to a financial planning context. Now, again, there's a lot on this screen, but it's this idea that when you're managing a portfolio, it only makes sense to manage a portfolio so long as it's actually aligned with your financial plan. It's nice to say, well, I want to invest in this much in stocks and this much in bonds, but if you don't actually think about it from a longer term perspective of what asset allocation will I need to achieve the goals that I've set, or what asset allocation do I need to create the cash flow I'm going to need to rely upon when I'm done working or when my work priorities shift or change, you have to look at it from a financial planning context. So what this is showing you is essentially an illustration of different, retirement planning or financial planning scenarios that tries to identify from a percentage probability perspective, which is kind of down in the lower half of the screen there, the likelihood that someone, or in this case, one person, would ever run out of money based upon goals they've set. So on the very left-hand side under needs, there's basic living expenses, there's health care, perhaps there's a new car. Maybe this person wants to travel a bit more, pursue a country club membership. Maybe they are interested in buying a new home, or perhaps if they, want to wish and dream, maybe they want a retirement celebration or a larger home improvement budget, right? So there's all these goals that this person had articulated that were important. But all of those only matter to the extent they're embedded within a financial planning context. So in this case, this person said, hey, I want to retire at 60 years old, and I want to understand how my investment portfolio will relate to my financial plan. Well, in this case, it delivered a 95% probability of success, right? So meaning trying to identify this time period where if I manage a portfolio and I stick to my asset allocation, there's a very high likelihood that I would never run out of money based on a lot of statistical modeling, knowing that rate of returns in the future are unpredictable. But trying to identify what that asset allocation strategy is part of what leads to these different changes, right? Well, if I want to retire a little earlier, or what if I want to pursue a larger home, or if I want my cake and eat it too, retire earlier and pursue a larger home. All of those have to be viewed within the percentage probability that that plan can be successful based on someone's investment strategy and asset allocation. They only make sense when they're done together. And then there's a variety of stress tests that we can use to help isolate these different decisions. So in some cases, it's the retirement date. In other cases, it's the living expenses. And in some cases, it's what's the asset allocation strategy. So if in this case, someone needed 80% of their money to be invested in things that are more growth oriented, like stocks, and the other 20% in things that are based in preservation, like bonds, whether you change that to 70% stocks or 90% stocks, how does that impact your confidence long term? So if you're looking to make a decision that is more strategic and rooted in a financial plan, but you're wanting to do something different with your asset allocation because you're nervous, this is a great framework to kind of guide that decision. Not basing it off of emotion, but basing it off of a financial plan. So this is an example of kind of comparing those two side by side, where maybe you'd make some adjustments in spending and how it could make a slight impact to the financial plan. The same can be done from an asset allocation context. Another thing you can do is protect your assets from volatility. So as I mentioned before, volatility is normal. Reacting to those things can only result in more harm than good most of the time. Even the experts that get paid handsomely on Wall Street to try to predict these things oftentimes get it wrong. So what you can do as an investor, as I mentioned before, be an international investor. Diversify. Don't just have all your eggs in only U.S. stocks or international stocks. Add bonds to the portfolio that people will want to buy. Bonds are basically a promise or an IOU from a corporation or a government that they will pay to you for lending them money. And those are considered safer investments than stocks, because stocks, you're an owner, which means you are subject to all the profits and all the losses of that company. And that's why it inherently comes with more risk. So adding bonds to your portfolio provide that element of stability, which I was referring to before, in that gold bar, where a little less volatility, a little less return for sure, but they're there to be an anchor in your portfolio to help you have something in your portfolio to manage around. And then, of course, there's alternative assets. Now, alternatives are meant to zag when everything else is zigging. So you have stocks and bonds and alternatives. Alternatives are nice to balance in your portfolio because it also helps to mitigate or essentially lower volatility risk. It makes that ride smoother and not so bouncy, which may ultimately make you a little bit better of an investor because you're not so worried about the very, very high highs or the very low lows. Now, I'd mentioned before that there is a mechanism to kind of managing that emotional roller coaster I was articulating before, and that's called rebalancing. Now, rebalancing is a very systematic, almost computerized process that helps to identify when to essentially set and reset your asset allocation strategy. Now, this is an example that goes over, basically a 50-year period of time, almost a 60-year period of time, that someone that would have had a 60% asset allocation in stocks and a 40% asset allocation in bonds, or what we call a 60-40 portfolio, for example. And that white bar right along the middle kind of identifies the band where that asset allocation should settle within over time. And if you otherwise don't rebalance, meaning you don't sell bonds when they've become more expensive and they're a larger part of the portfolio, say 45% of the portfolio, where stocks may be 55% of the portfolio, or if the other direction, when stocks are 65% of the portfolio and bonds are 35% of the portfolio, if you aren't proactively managing it to base it in that asset allocation, which we know would be aligned with the financial plan, you can kind of see what happens over time, because stocks, as we know, produce more return. That amount of green that you have in your portfolio becomes greater and greater and greater. And if you let this lie over a 60-year period of time, what was initially a 60% stock allocation became a 90% stock allocation 60 years later. Now, if you went to sleep or ignored your statements or didn't pay attention to this at all for a 60-year period of time, you might be great and very happy because you would have produced a lot of return and made a lot of money. But most people don't do that, right? Most people are paying attention to this regularly, sometimes annually, sometimes too frequently, like daily or even within a day. But their rebalancing process kind of naturally keeps it in that right asset allocation alignment, if it's aligned from a risk perspective with how much return you may need, but also balanced with how you feel about risk so you're not going to panic. Rebalancing kind of helps manage those human emotions. So you're always selling at relative highs and buying back at relative lows to kind of keep that asset allocation in one spot. So then how do we align that investment approach to you in more of a kind of uniquely tailored process? We've talked about how volatility is normal. We talked about those, inherent emotional biases and cognitive biases that people will have with managing money. And we talked about some of the ways of strategies you can use to kind of mitigate some of those emotional decisions. When we kind of dive into investment approach, we have to kind of bring it back to kind of the science of asset allocation again. What we have on screen is what's called the efficient frontier. Now, the efficient frontier, all it is it identifies individual portfolios of stocks, bonds, and alternatives. So diversified 20 means about 20% of your money in stocks. Diversified 100 means 100% of your money in stocks. And if you look at the axes on the screen, risk from low to high is on the bottom, and return from low to high is on the, from the bottom to the top there. And you can identify this as like, well, diversified 20% of your money in stocks. That means very low risk with very low expected return, which makes sense, right? As we looked at before, bonds and cash don't produce a lot of return, but there's certainly more comfort there. Whereas stocks can produce potentially a lot more expected return, but will come with a lot more expected risk. And trying to identify where the very best spot for someone would be comes back to the financial plan, comes back to a risk assessment and identifying, based on someone's priorities, their legacy goals, their long-term cash needs, their ability to handle risk and deal with kind of the emotional aspects of investing, help lead to where someone best fits on this efficient frontier, meaning you gain the most amount of return for every level of risk. You have an efficiently engineered portfolio. For some people, that might mean they're 100% stocks for a long time, and that diversified 100. For other people, it might be the diversified 50. And it doesn't necessarily mean that any portfolio is any better or worse than the other. It just means that what is the very best option that gives you the largest probability of being successful in your financial plan without sacrificing some of those emotional elements. Oftentimes what we see is that people will pick an asset allocation, and when they're not guided through an advisory process and trying to manage the emotional aspect, humans get in their way. What this slide articulates is it kind of looks at a 20-year period where if you compare simple indexes, in green, the S&P 500, and then in maroon there, that US aggregate index, that's essentially US bonds. Those are the returns that those indexes, so simply the collection of investments inside that basket, have returned over time. The S&P for 20 years, about 10% per year annual return. The global bond or US bond index, about 3% return per year. Of course, inflation's there over a 20-year period of time is only about 2.5% per year. And then you can see what the average stock fund investor and bond fund investor returns have been. The average return, which is interesting, for stocks actually falls short of the overall index by about 1% per year. You might be wondering what the difference is. The difference is investors that are trying to buy and sell around those different emotional points along that emotional roller coaster in hopes of being right. Maybe they panic because they're worried about markets, or maybe they sell at a point, have money in the bank, and then they try to invest at a different point when they hope they may be more successful. Over time, those compounded decision makings and not sticking to an asset allocation that's integrated with a financial plan amounts to a 1% return difference on a per year basis, which can be really substantial over a long period. And what you find with bonds is it actually is more significant. It's because people that are investing in bonds are trying to constantly jump back into stocks, or they're jumping back into their bank because they're so worried about investing in anything. So those realized returns that people earn, whether it's in stocks or bonds, can sometimes be substantially different than just how the investments have grown if you would have owned the index and never sold anything, because sometimes those emotions can kind of get in the way. But asset allocation is the most important decision anyone will make, and sticking to that plan is important. Because what do we find? Well, while there's many opportunities that I mentioned before that it can often feel different this time, oftentimes those feel different times are very abbreviated compared to the good times, right? The good will outshine the bad. I love this chart because it really helps to identify that same 100-year period of time for those largest 500 companies in the United States. And it looks at the green, the pattern and the overall length of a bull market versus the red, right? The downward pattern and the overall percentage decline and the length of a bear market. So for example, you look at something like 2008 and 9. So on the far right-hand side there, well, during 2008 and 9, we went through a significant downturn, right? So 27% in 2 months, another 51% in a 13-month period of time. So a really significant downturn, which felt terrible. And there was a lot of really uncertain timelines there with the housing crisis, global financial crisis. But then following that, 2-year period of time is one of the greatest bull markets in history, right? So it was a 131-month period. So when you look at the math, it's 10 years where stocks are essentially up 529%. And yes, that was followed by a 34% decline in 1 month, about a 1 to 2 month period of time. But then again, a large then return of 120% over almost a 2-year period of time. And of course, the pandemic happened. So the periods of time where those bear markets can be quite significant and really hard to stick to a plan. And when you have difficulty seeing the forest through the trees, this is what we're talking about with trying to stay disciplined. You're rewarded over the long run because those bull markets definitely outpace the bear markets, both in duration, so the length of time, and also total return. So don't jump out when it's red, right? And we don't know when those red patterns are going to happen. But we do know that those years where the returns are good are much more frequent than the years the returns are not. So this looks at almost that same period of time, but kind of looking at the positive and negative calendar year returns for that same S&P 500 index from 1937 to 2024. So the couple of takeaways here, way more years where markets are green, meaning have returned positive returns, than years where markets are poor. And we talk about US stocks, for example, on average grow 10 to 12%. But usually when the market's up, it's up a lot. So the average positive return, as you can see in the top right-hand corner, is about 20%. And when it's down, it's not down so significantly. It means there are those events like the 2008 where stocks were down 37%, 2022 when they were down, 25 to 30%. But on average, they're down not significantly, and they're up very significantly. So you could panic, in a given year and miss out on a calendar year return, which can be quite significant, which comes after those downturns if you're not careful and if you're not sticking to a disciplined process. But what about if you look at it just on a 1-day basis or a couple of day basis? This chart really helps to kind of give you that sense of if you just miss 1 day and you're looking at $1,000 of investment going back to 1990 through the end of 2024, so a 34-year period of time. If you miss 1 day compared to being fully invested, it may not mean much in terms of those compound returns on the right-hand side there. So for example, being fully invested, if you put $1,000 into the S&P in 1990, it grows to $34,000 at the end of 2024, about 11% annual rate of return every year. That's great. if you miss the single best day of performance in that 34-year window, the return difference isn't a ton. It's only 0.3% per year difference, but it's almost $3,000, $3,200 in total value. That's a significant amount of money on a $1,000 investment. If you miss the 5 best days in that time period, because usually the best days are directly after the worst days, and the worst days are when people make decisions that might not be aligned with their plan. The 5 best days, you've almost cut your return in half over that 34-year period. What about if you take a month off, right? So if you take essentially 25 of those best days out of that time window because it didn't feel good to invest, well, as you can see, you only got about 1/4 to 1/5 of the total return. Again, those percentages aren't a whole lot different, but the real dollars can be quite significant when compounded over a long period of time. So staying in, even when it's very difficult to stay in, because those good days do come following bad days. And those bad days can be frequent, but they can also be repetitive, right? We went through a lot of that here in the last 1 to 2 months. We've also seen really good volatility to get back on the right track. Where today, global stocks are about flat, even though, for example, US stocks are still in negative territory. So staying in the boat, right? Don't jump out, put on your life jacket, hang on, go back to harbor with the lighthouse if you need to and speak to your advisor to make sure you can actually stay in the boat for the long run. But it becomes, kind of a fool's errand chasing these best days or trying to get out when it doesn't feel good. So again, kind of coming back to that forest through the trees, talking about volatility being normal, talking about sticking to a long-term financial plan, understanding the power of the markets over a long period. And some people may say, well, I don't have a long period. I don't have 30 years to invest. I don't have 20 years to invest. Well, this argument about stocks producing more return than bonds can happen within even a 5 to 7 or even a 10-year time period. So what's important about this is you have to realize the asset allocation that you use to harness the power of the markets, blended with kind of the emotional aspects of how much you can tolerate, is a process that an advisor guides through with you to make sure that you're going to be able to stick to a plan to earn the return and not fall prey to those time periods when it just doesn't feel good to invest. And I would like to take this moment to move to kind of the question and answer portion of our presentation here today. So quite a bit of questions here in our Q&A, and let me pull up a handful here. Okay, so a good question here. So it says, I've already panicked. I'm sitting tight with kind of money and bonds right now. How do I get back into the market once I've, had that happen? Well, as I kind of mentioned before, missing those best days is important. So usually later's the wrong answer. Markets tend to go up more often, right, than they go down, as we kind of looked at. Those probabilities of the downturns, the 5 to 10% downturns, those happen and happen quite frequently, but they end up going up way more often than they go down. On any given day, it's kind of a coin flip. So stocks may go up 50% of the time on 1-a-day basis, but over a 1-month basis, about 60% of the time. And the further you go out, stocks more often go up than bonds. So certainly with more time, we have confidence, and it takes a little bit of blind faith on your regard. But again, that market timing piece, where if you're already out and trying to get back in, waiting until it feels better to get back in is going to be the wrong choice. And one of the ways you can kind of mitigate this and work through it is by going through maybe a dollar cost averaging exercise, right? So maybe targeting an ending asset allocation, which would be aligned with your financial plan, and strategically buying back in gradually over time, over a period of months, to get to a target asset allocation, which we know would give you the most confidence level that you never run out of money in the future. So if you find yourself where you're already, sitting tight in bonds or in cash and it just doesn't feel good to invest, it may not feel good to invest for a while. And if it does get to the point where it does feel good to invest, it's probably too late. Another question. I have a diversified portfolio and sometimes everything's down at once. How do I know if the plan is still working? That's a good question. I would say it kind of brings back the conversation of that financial plan, really to figure out what the asset allocation is that will provide you that best, long-term opportunity to stay invested, while also kind of using that rebalancing process that I was talking about before. And while there certainly have been times, even in the last 3 years, where both stocks and bonds have declined in value, certain parts of the asset allocation have actually performed okay. like alternatives in the last 3 years have actually done quite well, despite stocks and bonds, both in some cases performing poorly at the same time. So having a mix of different components in your portfolio, some of which will zig when others will zag, to buy and sell off of to help rebalance your asset allocation is important, because even though everything might be all down at once, it's not all going to be down at once, and it's certainly not going to last forever. So rebalancing to kind of stick to the overall asset allocation, and also kind of bringing it back to that financial plan to validate, do I have the right asset allocation to begin with? Because it's really easy to panic when everything goes down because it seems like there's no place to hide. Keep in mind that even though your wealth may have lessened in value because of the things you own, it doesn't mean that those companies that you own aren't good companies. It just means that no one wants to own them at that moment, or more sellers are there than buyers. But when people want to sell, there's always a buyer on the other side of the transaction. And as long as you remain patient, right, you can keep that discipline and otherwise, create more wealth long run if you don't panic, right? And then one last question we'll take today. Are there any frameworks you'd recommend to help evaluate a risk position? Yes. So I would say it's a great opportunity to have that risk assessment discussion with your financial advisor. So when you're going through periods of market strife where it just doesn't feel good to invest, trying to come back to like, what were the priorities we made when we first selected an asset allocation? What were our goals that were important? What's that required rate of return we're going to need to meet our financial objectives moving forward? How much tolerance do we have for risk now, that knowing that we're going through things that just don't feel comfortable for us and we thought we were going to be comfortable? And going through a very refined kind of risk assessment process, which is a combination of a quiz, right, taking some tests and answering some questions, but it's also a combination of kind of the wisdom with the advisor and their experience, which is the art. So it's the combination of the art and the science, which can lead back to like making sure you have the right asset allocation decision, to know that you've got the right risk position. That I think would be a tremendous framework to help determine that you have the right asset allocation both now but into the future. Now, that's all the time we have for questions today, but if your specific question is not answered, please go ahead and add that into the survey afterwards. We do take all the feedback in. It is very valuable to us. It'll pop up right after this webinar. But certainly thank you all for participating in our webinar here today. It's been a pleasure speaking to you about this topic. If you're looking to learn more information about Savant and what we do, certainly invite you to go to our website, savantwealth.com. There's lots of good information out there about investment process, financial planning, and certainly you can always schedule that 15-minute complimentary phone call with us. Again, super appreciate your time and attention. Thank you again, and have a great day.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.